Good morning, everyone, and thanks for joining us on this Friday morning. We really hope you find some value in today's quarterly income provider update with Henk. I am Dawie Karstens, part of Prescient's retail business development team, and I'll quickly set the scene before I hand over to Henk. I don't think Henk needs any introduction, but just in case we've got some new clients joining us today, Henk is part of our fixed income team and is mainly responsible for the day-to-day running of Income Provider. Perhaps just to recap, Prescient is a systematic investment manager where we remove all emotion from the investment process. So we don't rely on forecasts or gut feel when making decisions, but rather look at the hard facts. All of our funds are managed by a team, and as such, we don't have a staff fund manager. For Income Provider, I think it's important to remember what we try and achieve. We run the fund with an absolute return mindset with two primary objectives. Firstly, we seek to maximize real returns, and if I can borrow a phrase from Henk here, we focus on real returns and not peer returns. So every single year, we want to deliver CPI plus returns for our clients and CPI plus 3 over the long run. And then very importantly, we want to minimize the downside risk for Income Provider, and very specifically, our risk target is to not have any negative returns over rolling 3 months. When I had a chat earlier today with Henk, he said he'd rather talk about his hobby as a winemaker and how this year's vintage is looking than the risks we currently face after the latest medium-term budget speech. So with that, Henk, I'll hand over to you to take us through the more serious stuff. Thanks.
Thanks, Dawie, and appreciate everyone's time. Good morning. I am very well aware it's Friday today. It's a beautiful day in Cape Town, and I hope same for the rest of the country, wherever you might find yourselves. So I'm going to keep it brief, hopefully to the point, hopefully 1 or 2 light touches so that we get ready for the weekend. But again, thanks for your time, and let's get going. So what are we going to share with you today? I do want to start off with a very brief business update and some good news on the Prescient side. Then we go into the fixed income market, where we see a structural shift in the market, and specifically looking at cash and money market, where over the last number of years we were able to generate positive real returns in the cash side. This for us is probably not going to be as easy going forward, and it's now driven a search for real yield in the market. Luckily, with the income fund being a multi-asset income fund, and we shared this with you last time, we do have different tools we can still use to generate that real return. One such tool being the bond markets, and specifically looking at government bonds, we do still see elevated yields. And I would just like to touch on some of the risks there, dispel some of them, and maybe introduce 1 or 2 other risks that we see as why the yields are there. We do see lots of value, but it's very important to be cognizant of the risk. I will then look at the mini budget, or the medium-term budget policy statement that was tabled on Wednesday by our finance minister, Mr. Tito Mboweni. Maybe a little bit of a deep dive into that and see some of the risks that we've identified within that. And then I'll end off with just the positioning update on the Income Provider Fund, some of the changes we've made, where we see value, maybe for the outlook, some of the risks, how we still hedge against those. As Dawie very well positioned the fund, we are very cognizant on risk management, and that hasn't changed. And then if there's time at the end, we have some time for questions. So without further ado, just on the business update side, so Prescient reached 100 billion in assets under management in June this year. Obviously a big milestone for us, and with that I would like to thank all of you, our clients. Obviously without you that's not possible, but also internally I'd like to thank the PIM team. So the marketing team that set these things up for us gives us the opportunity to speak to our clients, the distribution teams that look after you on a day-to-day basis, and then also the team on the investment side. A lot of the stuff you'll see from me today is work generated by the broader team. And as Dawie said, we don't believe in star managers, so when I talk to you, it's really the team speaking and our views, and not a single view. So thanks to you, thanks to the team. We're very excited about the 100 billion, and hopefully from here we grow it, and with that grow your wealth as well. So what's the structural shift that we've seen? As I said, We don't think that generating real returns in the cash and money market side is going to be that easy going forward. There's a number of reasons for this, and I'm going to try and position that for you. But basically what we've seen with absolute yield levels being the lowest it's been in a very long time, potentially in most of our lives, the opportunity to generate real yields is not that easy. And with that, we've seen banks being lumped with a lot of cash. So they sit with a lot of cash due to various structural reasons. One, reaction to COVID and de-risking and some regulatory relief. And the combination of the lower yield and the bank sitting with cash and not really wanting to raise funding has seen money market rates at pretty much all-time lows. And if you look forward 1 year where inflation could be, and you compare that where money market rates will be in a year's time, we don't think it will be a positive real return story. So looking at some charts, just to start off with the US interest rate, I think it's very important. Obviously, the first building block of all asset prices. And what you can see here is one, yes, rates have come down, but two, more importantly for us, is you look at the outlook for interest rates in the US, it's pretty much around zero for the foreseeable future. Comparing that to the SA in the SA context, you can see similar story. So where we started the year out around 6.5, so that's end of January. You can see our rates have collapsed to around where they're now on the JIBOR basis 3.3. Similar outlook for that to stay around these levels for the distant future. So as I said, absolute yield levels very low. Then secondly, the banks sit with a lot of cash. So looking at this, comparing bank deposit growth over the last sort of 10 years, so zero at the start of the year and then how they grow, you can see in 2020 how cash deposits at banks exceeds what we've seen in previous years. This makes sense if people de-risk and get cash in, and two, as I said, with the SARB giving banks regulatory relief to shore up or free up some liquidity, that cash has remained in the banks. Why? If you look at this, so private sector credit extension, not a lot of credit extension happening in the market. One, obviously the banks are not taking on additional risk, and rightfully so, but also I think the appetite for risk in the general market has collapsed due to the COVID pandemic. Just looking at incorporation, so total loans and advances in the blue line, also for the year to date, and you look at compare that to the bank deposits in the red line, a clear deviation there that your banks are taking in cash but not really getting rid of it on the other side, leading to this excess cash reserves at the bank, or definitely on the banking level. And then, as I said, if you put all of that together and you stir that pot, you can see what's happened to funding spreads. So what are the banks paying us for putting cash with them? This is the funding spread on offer, and you can see from this clearly the banks aren't looking to raise a lot of funding, and they're not very competitive in what they're paying us on top of that. So if you look back to 2013, yes, spreads were also tight then, but remember back then yields on an absolute basis were about 2% higher. So still some yield to have had there, but this time around, unfortunately, low rates, low funding spreads, and low returns on the money market cash side. So what's one of the tools we use currently in the portfolio? And I think it's a fairly general theme in the market to still generate inflation plus. We see that as the bond market. We think that's one of the best ways to still generate it. Obviously, within the bond market, there's certain risks, and it's very important to understand those risks when specifically investing an income fund into some bond instruments. We've identified the area of the curve we like most, and I'll share some of that with you a bit later. But I would first like to start off with showing you the absolute value that we see in bonds. So what we're doing here is just to take the bond curve as it is currently and then project a total return in 1 year's time. So what are we going to return in the bond market if nothing happens in 1 year's time? That's the dark blue line. And then we said, okay, but let's stress that scenario a little bit. Let's shift the curve 1% higher, so yields up by 1%, meaning price drop. So that's the turquoise or blue line at the bottom. And then similarly, if you shift yields down 1% or price higher, that's the lighter green line at the top. And you can see across the term spectrum a lot of great yield that you can generate from bonds, obviously with risk, and it's important to position that, but we do think there's lots of value in owning bonds. So in the fund specifically, we focus on the 7-year area. where we've done the work on risk and return analysis, and we think that's appropriate for investors in an income fund. So just looking at that, even if bond yields were to go 1% higher from current levels, in 1 year's time, you would still be outperforming bank 5-year risk, and that's currently paying around 4%. So again, lots of value in the bond curve. Question then is, why is the bond yield so elevated? And the number one question we get asked by our clients is, what's the probability that the government can default on its local currency debt? There it's important to make the distinction between dollar-denominated debt and rand-denominated debt. We're lucky in SA, and the Treasury has managed this really well, that we have north of 90% of our debt in rands. That's very key. If you look at Argentina as the outlying example, where you have debt in dollars or not in your own currency, you have very little control over the price of that debt. If your currency weakens, obviously, how much you have to pay back balloons, and you very quickly find yourself in a default scenario. So that's something we don't have in SA. That risk is not there. If you look at the way they manage our dollar reserves in South Africa, they manage that to always match the debt they have on the dollar side. So prudent and well managed. Looking at the local currency debt then, and we think that the elevated yields are pricing in this default risk, which we think is very unlikely. If you look at history, very few countries have ever defaulted on their local currency debt. Venezuela comes to mind. So that was a complete regime change in the political side, which we don't see happening in SA. And then another one is Haiti, where there was a complete economic disaster from a natural cause. So that was a hurricane. But without those extreme events, it's very, very unlikely for a country to default on its local currency debt. So why do we say that? A default for us in SA would lead to a complete collapse of the financial system. And I'll show you the ownership, or who owns the bonds in South Africa, in a slide's time, but that really is the key to understanding this. So the banks own 23% of the issued bonds in the system. A bank, in principle, is a geared entity. So if they had to take any form of haircut on a bond, we would see a collapse of the banking system through a bank default. So we've seen National Treasury acknowledge this. So if you go read the budget that was released on Wednesday, or the medium-term budget, one of the key risks highlighted is the ownership of government bonds by the bank. So they're very well aware of this. So what's the alternative? We think printing money, or quantitative easing, for lack of a better word, is a much better solution than a hard default. I know the SARB is very anti-calling it that, but we have seen them being active in the secondary market buying bonds. So year to date, the numbers are about just under 40 billion of bonds that they have bought. So they are doing that. And for us, them buying bonds and creating cash in the system and avoiding a default is a far better solution and alternative than to default. So we really don't allocate any likelihood that SA will default on its local currency debt. So just to show the chart I was speaking about, so you can see the ownership of the bonds, banks owning 23%, non-residents, so foreigners, have sold their allocation down to about 30%, and we would really need to see them come back in our market as a bullish signal. But you can see from this that if we do have to have a default, it would be complete Armageddon in a scenario that we think shouldn't be central in when you're looking at the risk in the bond market. Just to show you some charts on quantitative easing then, it's not a new tool, you would know this. So quantitative easing round 1 in the US was in March 2009, post the global financial crisis, and you can see the last round, or QE4, was in response to COVID this year, and you can see how quickly they ramped up liquidity in the US, generating liquidity to really shore up markets and drive asset prices. I mean, we do think that the asset prices currently don't necessarily reflect the risk in the market, and for us that does increase the risk, and I'll touch on some of that later. But just to show you that printing cash or buying bonds in the secondary market from the reserve banks aren't all that new. Looking at South Africa, so this is looking at how much bonds the different EMs have bought as a percentage of their GDP, and you can see South Africa, very small percentage, but they have been buying. So that door is open, and for us, it's very likely that they would continue to do this if default risk increases. So then the question becomes, if they're printing money, then surely it should lead to something. And the argument always is inflation. And yes, we do think this time around the risk to inflation does increase. We don't necessarily see it coming through soon for this reason. So what we're looking at here is money supply, so the increase in cash in the system, or M2, and then looking and comparing that with the velocity of money. And you can see what's happened with the velocity of money. So as that has collapsed and the increase in money supply, that's not going to lead to inflation. We would really need to see the velocity of money picking up for the inflation risk to materialize. From what we can see in the near term, that is not a risk. We do think that the risk of inflation being higher than what's currently priced is there, but in the short term, we don't think printing money to get away from a default in the SA context would necessarily lead to runaway inflation. Okay, so then the default risk being dispelled from our side, let's look at the medium-term budget policy statement, MTBPS as it's called, and highlight some other risks to the bond market. We do see value, as I said, but we do also think that volatility will increase in the bond market going forward. And why do we say that? We think the intent is there from National Treasury to rein in this ballooning debt, but the main question, and even after Wednesday, still remains: can they deliver? So we see three key focus areas. Firstly, expenditure cuts, and really that speaks to the wage bill. They came out quite strong against that, freezing raises on the public sector wage bill. The question really is, are they able to deliver on that? We know that the unions are quite strong in SA, and we are likely to see a lot of pushback and potentially some unease across the broader economy around this. So can they deliver on those expenditure cuts? That really is a key driver of getting this debt down. The second part of it, obviously, debt is compared to your GDP, so we need growth. And from our senses, Eskom is still a big lagger on the growth side. With very suppressed growth, we're already seeing load shedding. So if we had to start growing, would Eskom be able to generate enough power? There was a positive news on that front this week with one of the new power plants being able to come online. But then the unknown one here, obviously, is the second wave around COVID. France going into lockdown today, US having the most number of cases on a daily basis since the start of the pandemic yesterday. So, I mean, there is this risk of a second wave, depressing economies and growth longer than what is expected, and potentially worsening the outlook for growth that's baked into the debt figures that we have here. And then the third one is the interest bill. I mean, interest rate in South Africa, if you look at the government curve, is too high. Economy can't grow on real interest rates that we have in the back end of the curve. So we need to see something to pull that down. It is a feedback loop in itself. So if we can get the growth and the expenditure cuts, interest should come down. But really, if we needed a strong message here for foreigners to come back into our bond market, buy down yields, and help them on the interest bill side. So what for us was very negative in the budget. So you would recall that the talks with the World Bank on the loan that we are trying to negotiate stalled around SOE payments, and then they go and give SAA an additional 10.5 billion on top of the 6.5 billion they're already using to bail out the debt. So 17 billion to a failing SOE in the form of SAA for us was a very bad signal. So not really sure how that plays out. We don't know why they would do that. For us, they would need to come out strongly here and send the right message. Definitely one to the World Bank so we can get this loan, but also to the broader foreign investor community so they can again have confidence in buying back-end bonds in South Africa. On the debt trajectory side, so obviously there was the active and the passive scenario in June. The sense was that they probably pictured somewhere in between, and that's more or less what they've done. So the question is, will they be able to keep this projection or the trajectory to 95% of GDP? Our sense is there's a lot of moving parts here, and it's not that certain. If you look at market reaction, I think it also speaks to that, not as positive as the market was necessarily expecting initially. An interesting point as well is that on the bond supply, we do think that they've raised enough in terms of the bond auctions, etc., but they haven't really reduced that. So the supply of bonds will still continue, and for us that increases the risk in the bond space 6.6 billion of nominal bonds a week is a lot of bonds to absorb in the market. The banks already own 23%. Our sense is the market also is quite long. We need foreigners or someone to come in and buy the bonds. So very little news around the size of the auction going forward, which leads us to think that potentially it stays the same. So summing all of that up, and to take words from Mr. Mboweni, they do recognize that the light is fading, and they need to start to walk while you still have light. So try and fix it now while we still have an opportunity. It's not the end yet, but the question is, can they deliver on the solutions that they've tabled? That will be the key for us here. And just to look at some of the charts here, and this you would have seen from us before, but really talk about the budget deficit and the difference between expenditure and revenue. The change there, or the dislocation, was in 2009, when then President Jacob Zuma and our Finance Minister Pravin Gordhan hatched their plan of growing expenditure by 5%, assuming a growth rate of 5%. And we all know that the spending the cash is quite easy. The growth side was the tricky part. So COVID's obviously made that worse. More cash to SMEs is making this worse. And with a budget deficit of around 16% for this financial year, we can see what the problems are. Then just looking at the debt trajectory, as I said, the dotted line was the active scenario sketched in June with the versus the passive one in the solid green line, and they've pitched this budget more or less in the middle. With all these moving parts, I think it'd be interesting to see how they get there. It's going to really be on delivery of this budget for them to get there. If not, it's unlikely to keep the debt there. So risk in the bond market, but good value. So to show that we're not alone, so this is us versus the US in terms of debt to GDP. You can see similar profile as the US also ramped up their debt. If you compare that to other EMs as well, you can see that pickup in debt this year. People needed to raise funding to finance COVID relief and try to get economies going. Obviously, debt is not a big problem if you have growth and low interest rates, but from the South African context, unfortunately, both of those are quite tricky here, and we really need to see those structural reforms for foreigners to come back. So looking at foreign flows, very important signal for us. What we can see from this is they've sold a lot of our bonds in March as the global market needed liquidity, and we haven't really seen them come back yet. Even with our yields being the highest, or real yields being the highest in the world, we're not seeing foreign buying of our bonds, and we need to see them come back. We need Treasury to be stronger in the reforms and deliver on that budget for them to see that. And unfortunately, on the fence, I think that foreigners are not yet back, telling us that the budget wasn't strong enough in terms of signaling that turnaround. So taking all of that, with the low real yields, we're seeing in cash, bonds seeing value. How are we positioned? So Darby very nicely positioned the fund earlier, and with our key focus as being absolute return, so inflation +3, and then use the assets that we do have at our disposal to still generate inflation plus, where we don't see that current in the cash market. And then very importantly, as Darby said, is our risk management. So where we allocate to assets, be very sure that we know how much we can allocate, how much risk budget that we have, that we don't jeopardize the minimum requirement of this portfolio. So just to show you that in a picture, you can see in the shaded area the focus on calendar years of every year generating inflation plus, some years more than others given where cycles are, but that focus of generating positive real returns is very important. And then if you do that by managing the risk well, this is the picture that you should see. So the risk on the bottom of the x-axis with return on the left, on the y-axis, left of the bond benchmarks, but a better return. We think the objective of investment should be to outperform your benchmark with lower risk. We can all take risk, excess risk, and get lucky and outperform. And the objective over time should be to outperform with less risk. And if you put all of that into a long-term chart, you can see the inflation +3 line, and this portfolio delivering handsomely on that. So doing what it says on the can, lower risk, inflation plus, and then you get that market beating return that you're looking for. Just on the positioning side of the portfolio, I shared this with you last quarter as well, just to go through the tools again that we have and that we are looking at currently to still generate this inflation plus return. So to start us off with there on the offshore side, we still see SA yields in dollars make sense, and there's a lot of yield that we can generate from buying dollar assets. So SA names that issue dollar assets and then swapping out the currency and getting that interest rate differential pickup and generating a rand asset that's yielding more than the equivalent rand asset in the local onshore market. On the duration side, I've touched on the bonds. Here we see a lot of value. We focus on the 7-year area. For us, we think that's the risk return sweet spot for an income fund, north of 7% yield. So with inflation around 4 over the long run, we think that inflation plus 3 lock-in is a great opportunity. Preference shares, we still like those. Here we focus on top 4 bank prefs. I'll show you a chart on how much excess yield we are generating from that. So smallish allocation, but a good yield generator away from cash to still deliver inflation plus for us. Inflation-linked bonds, anything that we can own that pays us on top of inflation or real return is a good asset. We see value in inflation-linked bonds. Again, we focus on the shorter term of the curve. With, if you're taking 3-year bank inflation-linked bonds at around 3%, if you think JIBAR was 3.3%, you don't have to have a lot of inflation for inflation-linked bonds to outperform cash. It gives the portfolio a very nice underpin to inflation. In this bucket as well, we group our renewable energy fund that we manage internally. Also inflation plus asset that's generating great real return for our clients, which you get access to via this portfolio. And then finally, property. Discounts remain deep. We see that the market is still fairly pessimistic, and I shared some thoughts around what we might like to see happen in the market before we can get back into it. One was on the payout ratio side. So a REIT has to pay out 75% of its earnings, and they traditionally do more than that. But there's some talks around them relaxing that and generating some cash on balance sheet. We think that's a good thing. The only thing that we need to see and understand is for how long is this relief going to last, for us to again have a sense of when they can pay us on top of the inflation asset being the property. And on the other side is on the loan to value side or the gearing of these counterparties. We'd like to see results come through so we can see how they've treated the valuation on the balance sheet as to not trigger what we call debt covenants and then trigger a liquidity event for the property counters. So look at the payout ratio, how long that's going to be, make sure we have a good sense of the valuations. I think it'll be very tricky in this environment to have a valuation cycle, see what that looks like, get some comfort around the debt levels and gearing of these guys. But then we think there's good opportunity. If you think in the long run, and I'm not comparing SA to Zimbabwe, but the only asset that kept up with inflation in Zimbabwe was the property market. When building costs should go up with inflation, that gives your building an underpin of inflation. And if they're paying out anything on top, that's inflation plus asset. So in the long run, property is a good place to be. Then some charts on all of this. So just comparing the local bond market or yields to the dollar bond equivalent in rands. That's the dark blue line, and you can see from this chart where we can focus in the income space, where we think it's appropriate in terms of years or term to maturity, so 3 to 4, 5 years. There's still a very good pickup for us to buy the dollar bond and swapping it out to rands. Back end of the curve, not so much there. We think SA yields are more attractive, but for the income portfolio, very good yield generation from the offshore component. Then this is a busy chart, and I apologize for that. I didn't want to share this on a Friday, but I really want to speak about the power of compounding. So one of the key things to fixed income investment and bond investment is obviously that the bond matures at par. So in 6 years' time, we've dispelled the risk of default, so you should get back your capital. What it also does is it pays you a coupon, so it generates cash flow for you. And if the risk that we've highlighted plays out and bond yields do continue to weaken, we said let us sketch that scenario and see what the total return of this bond does, even in that weakening yield scenario. So what we assumed was that every 6 months when the coupon pays, the yield is 25%, 25 basis points higher, and we get to invest that coupon at that higher yield. And you can see, comparing it to the dotted blue red line, which is the 5-year bank investment, the orange bar chart still outperforms 5-year bank funding, even in a rate scenario where they go higher based on all the risk that we've seen. And this is on the coupon effect, the compounding effect, and as well as the excess yield that we are generating in the bond side. So even in a negative scenario, we do think that where we can stomach the volatility and the risk profile suits an income fund, you are going to beat cash by being in bonds. Preference shares, as I said, paying us healthily on top of cash, and I just wanted to show you this chart again. So the difference between JIBAR cash rates and the average of the preference share dividend yield, and you can see March the spike, and it hasn't really come back yet. We think there's a lot of value in prefs, potentially a misconception in the market of the risk to prefs, and we think it's a great asset for the income fund currently. Okay, so putting all of that in the picture, this is the asset allocation as of the end of September. Main difference from previous quarter is the fixed bond piece, where we've increased our exposure there to the 186s. Fund duration of about 1 year, we think that's appropriate given current risks. Fund yield of 6.3, healthy margin on top of cash, but good mix of assets, well diversified, inflation underpin, and still getting us that inflation plus profile that we are looking for. So saying all of that, obviously the risk management part of this is very important as we move away from cash into other assets. How do we manage the risk in the portfolio? And I want to again share this picture with you because this is the way we think about it when we think about risk. So what I'm showing you here is as we make money in the market, we enjoy that. Obviously that's pretty obvious, but what we also know is when we lose money, we don't like it that much. But in reality, that's what happens. So the more we make money, the less we enjoy it. The more we lose, the greater the pain, and that's the key quadrant for us. And it's usually at that point in time where we see value in the market, and also people panic and sell. So what we try and achieve at Prescient is create that line. So manage the downside risk, spend some of your upside to buy protection, and what we've seen, if you compound that positive real return and minimize that downside loss, or manage that loss, you do outperform the market over time. So how do we do that currently in the portfolio? We've identified, apologies, 2 risk assets that currently carry a bit more risk for us than the rest of the portfolio, given where markets are with all this liquidity and where asset prices have been propped up to. So the first one is the offshore component. Again, we focus on SA names in the offshore space. If we do see risk in the markets, those yields would go higher and expose the portfolio. So what we've done is to add an option structure on the currency side to protect that. So if we see stress in the market, we do expect the rand to weaken. The weakness in the rand will benefit this trade or this structure, and that would then benefit the portfolio and offset the underlying risk that we have in the offshore piece. So comfortably feel that we've hedged out that risk. It was cost effective and just gives us that peace of mind that we need to hedge that piece of the portfolio. Secondly, on the duration side, obviously now we've bought bonds to increase our duration as we've locked into these higher yields. I've explained where we see the value, also the risk that we see, and even in a rising yield environment, we will outperform, but we don't want that volatility in the portfolio. So what we've done, again, we've bought put protection or put options against that. And what that means is where the market does sell off in terms of yield, the portfolio will be protected against that duration component and gives us the opportunity at the higher yields to again lock in those attractive yields. So identify the risk assets, look for cost-effective ways to hedge out the risk there, and create what we call an asymmetric return profile, and really a peace of mind that's very key for us. So that's what we currently have in the portfolio, and we feel that would sufficiently protect us if we had to see another market stress event. Just some final thoughts on credit. The credit market, suffered a liquidity blow as well during March. We haven't really seen a lot of liquidity return. Where we have seen liquidity return is on quality assets. So we do focus on quality assets in the portfolio. And you would know that we sound like broken records when we talk about credit. It's very important to understand the risk in credit and understand where in the credit cycle we find ourselves. So with spread compression and weakening balance sheets, we don't think it's the right time to load up on credit, especially not long-term credit. But what I want to try and show you here is that in our portfolio where we hold quality assets, we have seen spread widening or repricing or reflecting the risk underlying. And what we're looking at here is the bank spreads on the bond side, and you can see in March how that repriced. Banks have come back to market. They have issued again, reaffirming the wider spreads that we see pre-March. Unfortunately, with all this cash and with funding spreads coming in, we do again see a bit of compression on this side. which is not necessarily conducive to the risk we're seeing, but specifically in the orange line, the tier 2, we still see some good value there. Again, a busy slide, but the arrow is very key here. Speaking to the term risk in credit, very important to understand what that means when looking at a portfolio of credit. So the longer the term, the more risk. And we've managed our term down to about 1.5 years in the portfolio on the credit side. That's short. So if we had to see repricing in the credit market, the portfolio will be defensive and protected against that, versus a portfolio that would necessarily have a longer term of credit assets. So just in summary, very strong focus still on risk return. Real return is key for us. We've seen the structural shift. We recognize there's risk in the bond market. We feel we've sufficiently covered that risk with our protection strategies. Our credit is conservative. We focus on quality and liquidity so that, again, where we see opportunity, we can take those. And we focus on continually compounding these positive returns for you. And then just to finish off with, this time last year, so this weekend last year, the Boks smashed England and became world champions. The good news is we are still world champions. So yeah, take that, COVID. Thank you.
Thank you, Henk. It seems that the audience is going to give you a free ride on this Friday. It doesn't seem that any questions have come through. Perhaps you've answered anything or were very clear in your message that you've delivered. So with that, I say thanks to everyone for joining us and have a great weekend and good luck for the rest of the year. We'll be back next year, hopefully with some face-to-face interactions with Henk. Thanks a lot. Thanks, Henk.
Thanks, everyone.
Bye.
Cheers.